Thank you. Seri Saab, thank you so much. Mr. Grover, thank you so much for having me. I have about 5 slides. I'll quickly go through them in the next 15, 20 minutes, and then we'll be very happy to invite any questions and any conversation. Just to add on to what Mr. Sethi said, I think it has been repeated at a global level. Warren Buffett, in his annual letter to the shareholders only last year, said that because of these Tesla-type automated vehicles, the portfolio of insurance companies' motor line of business is going to undergo a major transformation. And that has been documented quite well. In fact, on the job aspects also, 2 years back so I was a consultant with Pricewaterhouse, and I used to manage India and Hong Kong markets. So while I was in Hong Kong, one day we figured out that 32 freshly qualified actuaries one fine day chose not to join an insurance company, but they joined Ant Financial, which was into financial services. So actuaries, which is a specialist field within insurance, are not joining insurance but a different field. I think there have been several instances around this, and we can talk about it, but let's focus on this conversation now. I'll be talking about how this InsurTech, digital, machine learning, deep learning, all of these new age technological changes are really impacting insurance, and they are, in my view, they are impacting at two levels. They are impacting the insurer and they are impacting the insured. So number of these insurance companies are adopting these digital technologies, and their own risk is changing because of that. And because their clients are adopting digital technologies, the external ecosystem is changing. And the word digital, in fact, in the last 5 to 7 years has been used, misused, and abused quite a bit. So let me set the context as to how I define digital, and you are happy to, and I'm happy to have your definitions. So in my view, there are 6 to 7 building blocks of anything which is considered digital. Number one, it must have data. It must have data management, something that can be churned around, it can be analyzed. Secondly, it must have advanced analytics. That is imperative. Just having data itself will not work. Telephone directories in India had lots of data, but they were never analyzed. So hence, analytics is important. Smart visualizations is very important. You need to visualize the data. You need to observe the trends and see where are things moving along. I think the most important aspect in any appropriate digital culture is talent, people and skills. If you do not have this, any amount of hardware or software will not be able to change anything. Automation, processes, all of this is important because this is what digitization is about. Cohesive and flexible infrastructure. 20, 30, 40 years back, we used to have mainframes, we used to have computers the size of this room. Now we are having much more computing power in your and my cell phones. We have computing power in clouds. So we need all of that to have an appropriate digital culture. And lastly, we need to have an external ecosystem. If you are digitally enabled in an island, that will not help. You need to have an external ecosystem through which you can play around, you can get some results. So in my definition, this is what digital ecosystem is, and we'll just look at how insurers are getting impacted in their business. So I think there are two levels how the insurers will get impacted. One is the new and emerging risks on their own business, and secondly, how they are able to respond to risks of their own clients. So the newer type of risks which insurers are going to face, or they are already facing, are these 4 or 5. Conduct risk, or this is the behavioral or the practice risk. Now, as practitioners of insurance, most of you, I'm assuming, would be conscious and sensitive to the fact that distribution is the single biggest lever which changes the dynamics of an insurance company's success. You have a good, extensive, deep distribution, your valuations, your top line, your bottom line, the entire dynamics change. And distribution does not come damage free. There have been number of instances in India and outside where instances of fraud, mis-selling, wrong selling have been there, and companies have been penalized, etc., etc. Because of which, about 3 to 5 years back, the entire concept of Robo Advisory came in, more on the life side than on the non-life side. Now, Robo Advisory is a fantastic concept. It basically says that deep learning or a machine learning based technologically enabled tool will be able to advise an individual customer what kind of product it should buy. So this has got 3 or 4 impacts. One, it can talk of maximum scale. An insurance agent, say in a top-notch life insurance company, can possibly close 3 to 4 cases in a quarter, high-level cases. But through a robo advisory, you can achieve very, very high scales. Error-free. So the quality of advice is error-free. Economics. It is much cheaper to have a robo advisory system within the company than to set up branches and hire agents, train agents, retrench agents, do all of that. So where is the risk? What is the problem in this? The problem in this is that all algorithms are as good as the team which develops them. They are as good as the coders which have developed them. And there have been examples, global examples, right from Tesla, Google, Microsoft, where biases have been identified. Gender biases are the most common which have been identified. Now, if an algorithm is not properly updated after a regulatory change, after a product change, after a price change, the very first advantage which I said of scalability gets defeated, because if the same problem would have happened, say a regulatory change has happened, an individual human agent would have perhaps impacted 5, 10, 15, 20, 100 people. A robo advisor going wrong will impact hundreds and thousands of people. So the scale of hit back on the insurance company is phenomenal. Second is the compliance risk. Now, because you have got so much of data and computing power at your behest, especially machine learning, I'm assuming most of you would be comfortable with the concept of machine learning. It basically means that instead of the human feeding in the data and the programming, the machine is smart enough to pick up the trends and self-program and self-code. So Sethi Saab, the jobs of coders itself is going away. So when these intelligent machine tools at the insurance company's behest are able to capture this data, marry it with the machine learning technologies, and they run into some compliance issues, for example, GDPR in UK, where data protection is sacrosanct, or even in India now the personalization of data and privatization of data is being questioned. And if through machine learning they are picking up the wrong indicators and bringing in a gender bias, religion bias, location bias, caste bias, which can be very extreme in India, it can lead to a phenomenal risk. You cannot have underwriting systems going berserk in this manner. Thirdly, cyber risk. I think Sanjoy spoke about it, and all of you are very well aware. The level of computing power, networking, interconnectedness between systems means you do not really need to hit Facebook's main servers in Iceland. A company in UK which had the API into Facebook servers could also impact Facebook as adversely as anyone else. So the interconnectedness between systems only makes it much more vulnerable. And we had 2 major cyber attacks in India last year. So I think that is indicative enough. People risk. As clients, as insurance companies, as economies move faster towards the digital ecosystem, it is important that insurance companies train their people on understanding, or at least respecting, the information, data, and the analytics that comes out of it. I think gone are the days, and Mr. Sethi, Mr. Grover would perhaps recall an institution called Tariff Advisory Committee, which used to bring out a fire manual, and there used to be a red book, and you would just measure if the door is of 6 inches, then the discount is given on fire underwriting, etc., etc. Now things are changing. Now people would need to understand if the client is, and I'll give you a real life example after this. If clients are having interconnected sensors and systems, can they be given better systems? Now just having a interconnected technological mumbo jumbo is not enough. So the underwriter at your end needs to understand what is it that is really going to come out of it. The example I was going to quote was last year at my previous firm, PwC. We had an audit client in Gurgaon, not very far from Delhi. In Gurgaon, this was a Japanese company. A factory had been set up, pretty large factory. It had only 7 employees. As an audit company, we even at PwC struggled to understand how do you audit an entity like this, who do you question, who do you ask for answers, who do you challenge, who do you penalize? But that was the fact. The Japanese company or the Japanese factory had just 7 employees. The entire thing was robotized. So these kind of things, when presented to either an audit company or to a risk manager, will have different nuances, and it is important that as representative of an insurance company or a broker, you are enabled enough to ask the right questions. Otherwise the client will also throw some technological mumbo jumbo and try to move on. Operational risk. I think enough automation has been done, whether it comes to policy administration or claims automation. And now the challenges that are coming in front of the insurance companies is how to make it future proof, how to really keep this tiger running without getting off it. So technology at any point in time is like riding a tiger. You can't get off it, you have to be on it at all times, otherwise you lose your edge. Now, if you become obsolete, even as a new age digitech insurer, without investing into newer technologies, you run the risk of becoming operationally obsolete. Can we afford that? Maybe that's a question the insurers would need to ask. Now, because of these digital changes, what are the kind of opportunities that come up in front of insurers? These are just high level, and I'm sure most of you know them. So improved identification and measurement of risk. Because we are now able to capture data, not just written on a piece of A4 form by the client, but from different sources, and marry it to different computing possibilities, whether machine learning or other sources, we have the capacity to bring out better results, which is why one of the best InsurTech companies in US underwrites a small, maybe a pen or a speaker in your house within 3 seconds, and they are really growing fast. It is this ability which they have now leveraged that they are moving on to. Another thing is, I think because there is so much of data, and again, Sanjay spoke about cyber risk. Insurance companies are working in tandem. They are working together to manage some of these global risks that hit them together. Cyber risk is one of them. Last year, in June, we had this massive global cyber attacks that impacted a number of companies, most in Europe, a few in India. And I think the collective response that came out from industries per se was indicator that industries would need to respond collectively, otherwise perhaps that could turn out to be difficult. Efficiency, I think that's a no-brainer. Digital technologies definitely bring in efficiency. They reduce costs, they make us work smarter, and robotic process automation has been one of the newer additions to this in the last 2 to 3 years, where people have experienced fantastic outcomes, along with modular technologies, cloud computing, and now we have 2-speed data systems as well. So different systems working at different speeds. They work on stochastic models, and they are also working in a regime which is perhaps not as fast as one would like. So these are different kind of responses, and of course it enables us to respond better on decision making. This is my last slide. Insure is perhaps experiencing the most transformative period. Now this is very well documented and known. Insurance sector is the least responsive when it comes to technological changes. It is not now, it is not yesterday, it has been there for ages and ages, and it has several reasons: legacy systems, resistance to change, etc., etc. So while insurance companies take their own speed and their own time in responding to technological changes, the world has moved really fast ahead. I'm repeating this, and again, this is very well known. People are saying now that Uber is the world's largest taxi company, but doesn't own taxis. Likewise, there is Airbnb, which is the largest hotel company, but has no properties of its own. So there is an asset-light model that came in. There are large technological changes that came in. Tesla has no engine. I have driven a Tesla car. It's a breeze. Now, how would a typical motor underwriter drive a Tesla? It has no engine. You just open it up. It's blank. You download technological upgrades on the car just as you would download on your phone. So the entire world is changing, and because of this, I think the rest of the world has moved much faster ahead, and insurance sector per se is playing a catch-up. We'll look at 4 or 5 trends as to why this catch up and what are the forces that are driving this. Consumer expectations. You and I use Twitter, Facebook, LinkedIn, Google on a day-to-day basis. A screen that you see will be very different from the screen that I will see. This basically means companies have matured enough, or these companies have matured enough to hyper localization. Now, you and I in our personal lives are experiencing this. This will automatically get translated when, as businesses, we are expecting services from our vendors, and insurance is a vendor business. So when your clients ask for insurance, chances are in the next few quarters or years, or it might actually be happening even now, even corporate clients, or at least the personalized clients, will be saying, we don't want to be treated like the 500th client that you just underwrote last week in a city 200 kilometer away. We are our unique entity. We have our own systems. I, as an individual, I have my own habits. Treat me as my own individual system, and please underwrite me as I would like myself to be. Can we do this? Yes, it can be done. How? Now, I'll come to the second point, and maybe then I'll answer this how. Competitive pressure. Insurance companies are not going to be competing against insurance companies to achieve success. They have actually not been competing against each other in the last few years since technological changes came in. They are now competing against anyone who has data and who can manage that data. For example, Amazon, Google, Facebook. And these are the real life examples I'm speaking about. 3 years back, Google started an insurance entity in US. They shut it down within 12 months, but that was for different business reasons. Amazon globally is now moving into insurance. In India, they have an NBFC license. Now, these are initial baby steps for them to taste how they can sell the product. And you and I know how Amazon sells. The screen that, again, I'm repeating this, the screens that you and I see will be very different. So that is an example of hyper localization. If I want to choose an insurance product tomorrow on Amazon, chances are they would want to be consistent with the experience of selling me a book or a phone or something else, which means the product or the service that I get on insurance will be very different, say if I were to go on any aggregator or any insurer's website. That is also a consumer expectation and both a competitive pressure. Regulatory constraints. Now, all of us know regulators globally. Now, insurance is the most regulated business in the world, anywhere in the world. And regulatory constraints have been only increasing on a daily basis. We had done a survey as PwC about 3 years back, and in Asia it came out, companies were spending anywhere between 16 to 20% on compliances. That's a huge cost of compliance. It is not affordable. It is not sustainable. Likewise, the interest rates have been going low. In fact, if you were to trust the magazine Economist, in its latest issue, it is talking about limited recession, which means they are saying recession might happen, but it will not be a global one, it will be selective. What it only means is that once these things begin to step in, the willingness or the ability for the clients to pay for insurance is not going to be very high. These regulatory constraints and low interest rates will be a problem even for your clients, even in a different sector. So their pushback against insurance is going to come much more faster. New or unknown risks. I don't need to repeat this. I think all of us know the nature of economy has been shifting. You and I have created much more data in the last 2 years through our cell phones, our computers, than has ever been created in the recorded history. That's a lot of data that has been created. Now this data is not going to be lying in some servers in Iceland. It is being processed for you and me. Likewise, the computing power, right from 1970s till date, which is about 48 to 50 years now, it has doubled every single year. That's phenomenal computing power. Just look at these two aspects, computing power and data coming together, and you would understand how risks are becoming different and much more stronger. 10, 15, 20 years back, perhaps the largest companies in the world were General Electric or ABB or Siemens. Now I think we talk of Apple and Google and Facebook, if you were to look at the global markets. It only means that the nature of assets has also shifted. A General Electric would have physical assets. A Facebook has got IP, it has got data, it has got servers. When Facebook came under pressure earlier this year, it was not because of anything else, it was just because their own data got compromised. So the nature of risks is changing. And of course, use of Industrial 4.0. We all know about how IoT is now getting more and more prevalent. So you will be having clients, much like I had a client last year, where in a factory they would have sensors and responders in different parts, and those will be connected through IoTs, and you can better manage risks, you can understand risks, you will be alerted to claims much sooner. So I think all of these are changes that are beginning to happen, and when we talk of risk management, it is important to understand that the single biggest factor impacting our lives right now is technology, digital. It is going to impact you as an insurer. It is going to impact you because your clients will get impacted. Happy to take any questions on this, please. Okay, now, thank you.
We can have some expert comment from, please come.